In 2013, a ProPublica investigation found that 18 of the wealthiest Americans paid an average federal income tax rate of 3.4%, not 34, 3.4. Some years, a few of them paid nothing at all, and none of it was illegal. For most people, that number lands as a headline and then fades. It feels like a story about someone else's world, but the mechanism behind it is not reserved for billionaires. It is sitting inside the tax code right now, available to anyone who understands how it works. Here's the gap. You have been taught that income is how you get ahead. Earn more, save more, invest more. That is the path. What nobody explains is that earning income is the least tax-efficient way to accumulate money. Every dollar you earn gets taxed before you can do anything with it. But there is another way to access cash from your assets without ever triggering a tax bill. Not a loophole, a design feature. So the question is, how do you generate cash from wealth you have already built without the government taking a cut the moment you touch it? That is the mechanism at the center of this video. It is called buy, borrow, die. My name is Alex, and if you have ever watched your investment account grow while still feeling like money is tight, stay with me, because the frustration you are feeling is not random. And I'm going to show you exactly how this three-step strategy works, and why the stepped-up basis rule is the part that makes the whole thing permanent. Once you understand this, you will stop seeing selling as the only option and start asking a completely different question every time you need cash. The reason this strategy works traces back to one specific difference in how the tax code treats earners versus owners. And that difference changes everything about which path you are actually on. Nobody sits down and explains this to you. Not in school, not at your first job, not when you open your brokerage account. You are handed one set of rules and told to follow them. What you are not told is that a completely different set of rules exists, and the people using those rules are playing an entirely different game. The difference between an earner and an owner is not about income level. It is not about how hard someone works. It is about the sequence of events between making money and keeping it. Specifically, it is about when the government steps in. Follow the earner's path first. Sandra is a marketing director in Chicago. She earns $112,000 a year. Before she sees a single dollar of that, the federal government has already claimed its share. In 2026, her income puts her in the 22% federal bracket. Add Illinois state income tax at 4.95%. Add Social Security and Medicare on top. By the time her paycheck clears, she's taking home somewhere around $73,000. The tax event happens before she has any choice in the matter. Earn first. Get taxed immediately. Spend what remains. Now follow the owner's path. Victor is a civil engineer in Phoenix. 10 years ago, he put $85,000 into a broad market index fund and left it alone. That position is worth just over $230,000 today. The gain is roughly $145,000. Victor has not paid a single cent of tax on that gain. Not because he found a loophole, because he has not sold. No sale means no taxable event. The IRS has no claim on wealth that has not been realized. Victor's money has been compounding quietly, untouched, for a decade. That gap right there is the foundation of everything in this video. Sandra gets taxed on the money the moment she earns it. Victor accumulates wealth, and the tax clock does not even start. Same country, same year. Two completely different experiences of how money works. And here is where it gets more interesting. Victor does not just let the money sit unused. He has a life to fund too. So when he needs cash, he borrows against his portfolio. His brokerage offers him a line of credit using his investments as collateral. He draws what he needs. The portfolio keeps growing. The IRS sees nothing because a loan is not income. You cannot be taxed on borrowed money. That is not a gray area. That is just the rule. Sandra, meanwhile, needs cash for a home renovation. Her options run through tax at every turn. Work overtime and pay income tax on the extra earnings. Pull from savings she already paid tax on once. Take a personal loan and repay it with after-tax dollars. Every path she takes costs her something to the government first. Victor's path does not. Now, a fair objection here is that Victor started with $85,000 to invest, and not everyone has that. That is true, but the mechanism does not require a large portfolio to begin with. It requires understanding the principle early enough to let it work. The strategy scales, and the entry points are more accessible than most people assume. The deeper point is this: the tax code is not neutral. It taxes earned income aggressively and leaves accumulated assets largely alone until a sale occurs. That asymmetry is not an accident. It is a design choice, and it has been sitting in the code for decades. Once you see the two paths clearly, the next question is obvious. What exactly are the three steps that owners use to move through this system? Because buy, borrow, die is not just a phrase. Each word is a specific action, and together they form a sequence that changes the outcome entirely. 3 words. That is the entire strategy: buy, borrow, die. It sounds almost too simple for something this consequential, and that simplicity is part of why it gets dismissed. People hear it and assume there must be a catch, a fine print somewhere, a step that only works if you already have a team of lawyers on retainer. There is not. The catch is just that you have to understand what each word actually means and why the sequence matters. Start with buy. This is not about picking the right stock or timing the market. The buy step is about acquiring assets that appreciate over time and then holding them. Broad index funds, real estate, a diversified equity portfolio. The specific vehicle matters less than the behavior. You are building a base of assets whose value climbs because the entire strategy depends on having something worth borrowing against later. Without appreciating assets, steps 2 and 3 do not exist. The buy step is the foundation, and it requires patience more than it requires genius. Now, borrow. This is the step that rewires how most people think about accessing money. The conventional instinct, the one most of us were raised with, is that when you need cash, you either earn it or you sell something you own. The borrow step says there is a third option. You use your assets as collateral and take out a loan. The cash lands in your account, you spend it. And because debt is not income, the IRS is not involved. No sale occurred. No taxable event was triggered. The asset stays in place and keeps compounding. Here's a way to think about it that makes the logic click. And imagine your investment portfolio is on an escalator, moving steadily upward. Selling is stepping off that escalator. The asset stops growing the moment you exit. Borrowing is reaching into your pocket while staying on the escalator. You get the cash you need, and the ride continues. The two outcomes, over 20 or 30 years, are not even close to comparable. Consider Thomas, a dentist in Nashville. He has been investing steadily for 12 years, and his portfolio sits at $380,000. He wants to fund a significant home renovation, around $150,000. He has 2 options. He can sell a portion of his portfolio, trigger a capital gains tax bill, and watch that chunk of his investments stop compounding forever. Or he can pledge his portfolio as collateral, draw a loan at roughly 6.5% annual interest in 2026, keep his entire portfolio in the market, and repay the loan over time from his regular income. The interest cost is real, but it is a fraction of what he would lose in taxes and foregone compounding if he sold. Thomas borrows. The escalator keeps moving. Now, die. That word is doing the most important work in the sequence, and it is the most misunderstood. It is not morbid for the sake of being memorable. It is describing a specific tax event, or more precisely, the permanent elimination of one. The die step is where the accumulated gains that were never taxed during a lifetime do not simply get deferred to the next generation. They disappear from the tax record entirely. That is not a figure of speech. It is a specific provision in the tax code, and it is the mechanism that makes this strategy generational rather than just personally useful. But to understand exactly how that works, you need to see the math first, because the gap between selling and borrowing is not just conceptual. When you run the actual numbers on a sell versus borrow decision, the difference is striking enough to change how you think about every significant financial choice going forward. So let's run it. 15 years ago, Elena, a graphic designer in Seattle, put $100,000 into a broad index fund. She did not touch it. She did not rebalance obsessively or panic during downturns. She just left it alone. Today, that position is worth $450,000. Her original investment was $100,000. The gain is $350,000, and every cent of it is unrealized. No sale, no tax, no IRS involvement. It is paper profit, sitting there, still compounding. Now, Elena needs $250,000. She's buying a rental property. She has 2 paths in front of her. Path 1. She sells enough of her portfolio to cover it. That sale is a taxable event. In 2026, long-term capital gains on that sale would be taxed at 20% federally for someone at her income level. On top of that, the net investment income tax adds another 3.8%. Combined, that is 23.8% applied to her realized gain. On $250,000 worth of gains, her federal tax bill lands at roughly $47,000. That money leaves her account the moment she files. Gone, not invested, not compounding, just gone. And the shares she sold stop working for her permanently. They're off the escalator. Path 2. She borrows against her portfolio through a pledged asset line. Her full $450,000 portfolio stays in the market. She draws the $250,000 as a loan at approximately 6.5% annual interest in 2026. She services the interest from her regular income. The tax bill is zero. The portfolio keeps compounding. Now here is the number that tends to stop people mid-sentence. That $47,000 tax payment is not just $47,000. If that money had stayed invested and compounded at 7% annually for 20 years, it would have grown to roughly $182,000. That is the real cost of selling, not the tax bill itself, the future value of the tax bill. $182,000 in wealth that Elena would simply never have, not because she spent it, but because she handed it to the Treasury at the wrong moment. The interest she pays on the loan over time is real. It is a genuine cost, and it should not be glossed over. But at 6.5% on a loan she is managing carefully, that cost is predictable and controllable. A one-time tax hit of $47,000 plus $182,000 in lost compounding is neither of those things. It is just a permanent subtraction. Elena borrows. The portfolio stays intact. The tax clock never starts. And that is the sell versus borrow decision in plain numbers. One path costs you immediately and permanently. The other path costs you incrementally and manageably. Over a long enough timeline, the difference between those two choices is not marginal. It is the difference between a portfolio that kept growing and one that was quietly drained at the exact moment it had the most momentum. But here is the part that most people never reach in this conversation. The borrow step is powerful. The real jaw-dropping mechanism, the one that makes this strategy permanent rather than just clever, is what happens at the very end. The stepped-up basis rule is not about deferring the tax on those gains. It is about erasing it, and understanding exactly how it works changes the way you think about holding assets for the rest of your life. Here is something worth sitting with. Every dollar of gain that Elena never triggered a tax event on, every dollar that Victor let compound untouched, every loan that Thomas drew against his portfolio instead of selling, none of that deferred tax ever has to be paid. Not by them, not by their children, not by anyone. It does not get pushed down the line. It gets erased, permanently. And the mechanism that does it is one of the least discussed provisions in the entire U.S. tax code. It is called the stepped-up basis. And once you understand it, the third word in buy, borrow, die stops sounding morbid and starts sounding like the most important word of the three. Here is the mechanics. When you purchase an asset, the price you paid is recorded as your cost basis. And that number is what the IRS uses to calculate your gain when you eventually sell. Buy shares at $12, sell them at $300, your taxable gain is $288 per share. That is the standard math. That is the number most investors assume will catch up with them eventually, no matter how long they defer. But when you die holding those assets, something unusual happens. The cost basis does not transfer to your heirs at the original purchase price. It resets to the fair market value of the assets on the date of your death. That is the step up. The IRS essentially draws a line at the moment of inheritance and says, everything before this point no longer exists for tax purposes. The entire history of appreciation is wiped clean. Your heirs receive the assets as if they bought them at today's price. If they sell the next day, their taxable gain is zero. Not reduced, not deferred, zero. Now put that together with the borrow step, and the full picture comes into focus. Consider William, a retired pharmacist in San Diego. Over a 40-year career, he built a diversified investment portfolio, now worth $2.8 million. His original cost basis across that portfolio is roughly $320,000. The unrealized gain is approximately $2.48 million. If he sold everything today, his federal tax liability, at the 23.8% combined rate, would be around $590,000. That is more than his original investment, just in taxes owed. William never sells. He borrows against the portfolio through a pledged asset line, drawing roughly $120,000 a year to supplement his retirement income. He pays the loan interest from a small pension he still receives. His portfolio continues compounding. The loan balance grows slowly, but stays well below 30% of the total portfolio value. The IRS has not been involved once. William passes away. His portfolio is now worth $3.4 million. His estate carries an outstanding loan balance of $480,000. The estate sells a portion of the assets to repay the loan. Because the cost basis has been stepped up to $3.4 million on the date of death, that sale generates virtually no taxable gain. His heirs inherit the remainder, roughly $2.9 million, with a clean slate. The $2.48 million in lifetime gains that would have cost nearly $600,000 in taxes? Gone. Not deferred, eliminated. That is the die step. Not a euphemism, a mechanism. And I want to be honest about something here. At Williams' scale, this strategy is operating at full power. But the stepped-up basis rule applies at every level of asset ownership. The question is not whether the mechanism works for smaller portfolios. It does. The question is how someone with a more modest starting point actually gets into a position to use it. And that is exactly where the on-ramps for regular investors come in, because the entry points are more accessible than most people have been led to believe. At some point in this conversation, a reasonable thought surfaces. This is a strategy for people who are already wealthy. You need millions in assets before any of this applies to you. And if that is where your head went, I understand why. Every example so far has involved portfolios in the hundreds of thousands, or the millions. But that framing is actually backwards. The strategy does not require wealth to access. It requires understanding the mechanism early enough to grow into it. And the entry points exist at levels most people would not expect. There are 3 main on-ramps. Each one operates on the same principle. Each one has a different starting requirement, a different risk profile, and a different level of flexibility. Knowing which one fits your current position is the practical takeaway from everything covered so far. The first on-ramp is a margin loan. If you have a standard brokerage account, you likely already have access to this. A margin loan lets you borrow against the value of the securities you hold. Most brokerages in 2026 will lend you up to 50% of your portfolio's value on margin, though borrowing anywhere near that ceiling is not advisable, and we will get to why in a moment. The barrier to entry is low. A brokerage account with a few $1,000s in it can technically qualify. Margin loan interest rates in 2026 sit somewhere between 6 and 9%, depending on the broker and the loan size, with larger balances generally attracting lower rates. The catch with margin is that it is the most reactive of the 3 options. If your portfolio drops sharply, your broker can issue a margin call, demanding you deposit more cash or sell assets immediately to cover the shortfall. That forced sale at the worst possible moment is exactly the outcome the strategy is designed to avoid. Margin works, but it requires discipline and a significant cushion between your loan balance and your portfolio value. The second on-ramp is a pledged asset line, sometimes called a PL. This is the preferred tool for investors who have reached a certain threshold, typically around $250,000 in investable assets. A pledged asset line is a flexible line of credit extended by a bank or brokerage against your portfolio. You draw what you need when you need it and pay interest only on what you use. The rates in 2026 generally run between 5.5 and 7.5% for well-qualified borrowers. The key advantage over a margin loan is stability. Pledged asset lines are structured to give you more time and flexibility if the market moves against you, making them significantly more suitable for the long-term borrowing this strategy depends on. The third on-ramp is one that a large portion of the audience already has access to without realizing it. Home equity. A home equity line of credit, or HELOC, operates on exactly the same principle as everything described in this video. You are borrowing against an appreciating asset without selling it. In 2026, HELOC rates for well-qualified borrowers are running in the 7 to 8.5% range. The portfolio in this case is your house. The unrealized gain is your equity. The mechanism is identical. What ties all 3 together is the same underlying logic. You own something that has grown in value. Instead of selling it and triggering a tax event, you borrow against it, preserve the compounding, and service the debt from income rather than from the asset itself. That last part is not a minor detail. It is actually the most important discipline in the entire strategy, because this only works cleanly when the borrowing is controlled and the leverage stays within safe limits. When it is not, the same mechanism that builds wealth quietly can unwind it catastrophically. That is the risk side of leverage and discipline, and it is worth understanding clearly before putting any of this into practice. Every powerful tool has a failure mode, and the failure mode for this strategy is not subtle. It does not creep up slowly or give you time to course correct. When leverage goes wrong, it goes wrong fast, and the losses are not theoretical, they are permanent. So before this becomes something you consider applying, the risk side needs to be understood just as clearly as the upside. Leverage is borrowed money working inside your portfolio. When the assets go up, leverage amplifies the gain. When the assets go down, leverage amplifies the loss. And the asymmetry matters enormously. A 50% drop in a portfolio requires a 100% gain just to get back to where you started. If you are borrowing against that portfolio while it is falling, the math gets worse faster than most people intuitively grasp. The clearest cautionary example of what undisciplined leverage looks like at scale happened in 2021. Bill Huang, the founder of Archegos Capital, borrowed aggressively against a concentrated set of positions using a structure called total return swaps. His exposure at peak was estimated at around $100 billion, built on a fraction of that in actual capital. When a few of his core holdings started to decline, the banks holding his positions began selling to cover their exposure. The selling accelerated the decline. The decline triggered more selling. In roughly 2 days, an estimated $20 billion in personal wealth was erased. The banks lost billions too. The entire structure imploded because there was no cushion, no diversification, and no discipline on the leverage ratio. That is the extreme version. But the mechanism that destroyed Huang is the same mechanism available at every brokerage account in the country. The difference between a useful tool and a catastrophic one is entirely in how it is used. 3 rules keep this strategy safe. They are not complicated, but they require consistency, especially when the market makes them feel unnecessary. Rule 1: diversify. Never borrow against a single stock or concentrated position in one sector. The entire strategy depends on the underlying asset recovering from temporary declines and continuing to appreciate over time. A broad index fund has done that historically with reliable consistency. A single company stock can go to zero and stay there. Borrowing against concentration is not investing. It is speculation with borrowed money, and the downside is unrecoverable. And rule 2: stay low on the loan-to-value ratio. Keep your total borrowing at or below 30% of your portfolio's value. If your portfolio is worth $400,000, your loan balance should not exceed $120,000. That cushion means a significant market decline, even a sharp one, does not immediately threaten your position. In 2026, with equity markets carrying real volatility risk, that buffer is not conservative, it is necessary. Investors who stretch to 40 or 50% loan to value during calm markets have repeatedly found themselves forced to sell at the worst possible moment when conditions shifted. Rule 3: cover the interest from income, not from the portfolio. This is the discipline that holds everything else together. If you are selling assets to pay the interest on your loan, you are defeating the purpose of borrowing in the first place. You are triggering the taxable events you are trying to avoid and eroding the asset base the loan depends on. The interest has to be serviceable from your regular cash flow. If it is not, the loan is too large. Follow those 3 rules, and the strategy behaves the way it is supposed to. Break any one of them, and the elegant mechanism described in this video becomes the thing that undoes the portfolio it was meant to protect, which brings everything full circle. Because the recap is not just a summary of steps, it is the mindset shift underneath all of them, the one that separates how earners think about money from how owners think about it, and why that difference compounds just as surely as the assets do. Here's the realization that ties everything together. The game is not rigged against you because someone is cheating. It is rigged by design, and the design rewards one behavior above everything else: owning assets and never selling them. That is not a conspiracy. It is just how the incentives are structured, and they have been structured that way for decades. A few things to carry forward. Earned income gets taxed first and hardest. Unrealized gains do not get taxed at all until a sale occurs. Borrowing against assets is not income, And when you die holding appreciated assets, the tax liability on a lifetime of gains does not transfer. It disappears. Start noticing where taxable events appear in your own financial decisions. Every time you consider selling something, ask whether borrowing is a viable alternative. Not always, but more often than you think. The question worth sitting with now is this. The stepped-up basis rule has existed for decades, but there are ongoing conversations in Washington about whether it should. If that rule changed, the entire third step of this strategy would change with it. What does the buy, borrow, die playbook look like in a world where the stepped-up basis no longer exists? That is worth understanding before it becomes relevant. If this reframed something for you, share it with someone who is still playing by the first set of rules. And if you want to keep pulling on this thread, subscribe, because the next video goes somewhere most people are not expecting.